Anthony Grasso here, bringing you financial news that you can use. In this particular video, we're going to do a stock analysis review on NextEra Energy. Is this recession-proof, low volatility, dividend growth, clean energy utility worth investing in right now? Especially with the roller coaster ride that we're seeing in the markets right now. Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections. Then finally, I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. So as always, this video is brought to you by Webull, where you can get it's an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get up to 12 free stocks by using my referral link in the description down below. All right, so what is NextEra Energy for those who don't know? Well, through its subsidiaries, generates, transmits, and distributes and sells electric power to retail and wholesale customers in North America. The company generates electricity through wind, solar, nuclear, which is 20% of their portfolio, coal, and natural gas facilities. It also develops, constructs, and operates long-term contracted assets that consist of clean energy solutions, such as renewable generation facilities, battery storage projects, and electric transmission facilities. It also sells energy commodities and owns and develops and constructs, manages, and operates electric generation facilities in wholesale energy markets. Now, as of December 31st, 2021, the company had approximately 28,564 megawatts of net generating capacity, approximately 77,000 circuit miles of transmission and distribution lines, and 696 substations. It serves approximately 11 million people through approximately 5.7 million customer accounts in the east and lower west coast of Florida. The company was formerly known as FPL Group and changed its name to NextEra Energy in 2010. The company was founded in 1925 and is headquartered in Juno Beach, Florida, not too far from me. All right, so let's look at some of the news of the company right now. All right, so they reported that they pay shareholders a quarterly dividend of 42.5 cents per share. Now, they will go ex-dividend on Monday, meaning the stock will trade lower to reflect the payout. In other words, the stock will likely open 42.5 cents lower than it would have opened on any other day. In order to be eligible to receive the company's dividend, shareholders must own the stock prior to the ex-dividend date, in this case, Monday. Shareholders who own NextEra Energy as the end of today are eligible to receive the 42.5 cents dividend payout for every share that they own. Now, according to the company, the dividend will be paid out to shareholders on September 15th, 2022. Investors then will be able to either reinvest those dividends back into the stock or use the payment in some other way. And I'll get into this stock dividend in a little bit. But first, let's go ahead and look at the company itself fundamentally, this utility company, and let's see how it's doing fundamentally. All right, so the company is currently trading at $89.10 a share with a market capitalization of roughly $175.7 billion. Now, the company is projected to have about $20.8 billion of revenue for the 2022 with positive earnings of around $4.7 billion. Now, the revenues are projected to increase over the next few years to around $25.28 billion by the end of 2024, which is significant. And it should have positive earnings of $6.79 billion. Now, the revenue is forecasted to increase around 10.9% per year, and it's not considered high growth, but it's still good nonetheless. And the earnings are forecasted to grow about 14.5% per year. This is also not considered high growth, but it's high quality earnings of the company. Now let's look at some of the key measures of the company right now and do some analysis work on this company real quick. All right, so because the company is in the utilities industry and has positive earnings, the price to earnings growth and the price to earnings ratio, the PEG and the PE, and the price to book ratios are the most appropriate valuation measures. The price to sales ratio is less instructive than the PEG or PE since the company has positive earnings. Therefore, the company seems highly valued. It definitely is highly valued, with a PEG valued at 7.57 times, one of the highest in utility sector industry. Now, which is supported by a PE ratio of 68.1 times. That is also among the highest in the industry, which the industry average is only 21.7 times. Now, it is also expensive with the PE ratio compared to the peer average. The peers are only trading at 23.7 times. Now, if you look at the share price versus the fair value, though, looking at future cash flows, for this estimate, you use the discounted cash flow model. It's trading below the fair value. Our estimate of fair value is $59.34 a share. So it's trading above the estimate of fair value. Now, if we look at the profitability of this utility company, based on their operating profit margin and operating margins, the cost structure eats up a higher percentage of the revenues than most of the companies in the utility sector. Yet the company is still profitable with an operating margin of around 14.8%. Now, the current profit margin after that 14.8% is lower than last year, which was 18.7%. Now, this is a dividend paying company. Now, it's not the dividend is over the past 12 months, they paid more in dividends than it earned. And over time, this can't continue. But it is a notable dividend, though. It pays 1.9%, which is higher than the bottom 25% of the dividend payers in the United States. And it's low compared to the top 25% of dividend payers in the US market, which pays roughly around 4%. It is a stable dividend, though. Per share have been stable for the past 10 years, and it's a growing dividend. The dividend payments have increased over the past 10 years. So that upcoming dividend payment, the payment date is going to be, as I said, September 15th, 2022. The company is paying out more than 100% of its profits, and its cash flows are negative right now, and the trailing yield is 1.9%. Now, this is lower than the top quartile of American dividend payers of 4%, but and lower than the average of the industry peers of 2.8%. But the revenue and earnings are forecasted to grow significantly, not significantly, but they're forecasted to grow over the next few years. So I'm not too worried about it. They wanted to maintain a good growing dividend, and their future projections of revenue and earnings will definitely cover that in the future quarters. Now let's look at the growth rates analysis. Now, because we saw earnings decline in spite of positive revenue growth during the last 12 months, additionally, the average company in the utility industry was able to improve its earnings result over the same period. Now, the earnings trend is positive, though, but they have declined by 19% per year over the past 5 years. Now, but they're forecast to grow about 14.47% per year for 2023 and 2024. So even though they've been on the decline for a few years, now it's going back up. And finally, let's look at the financial strength of this company. Now, the debt to total capital ratio is roughly around 58.7%, and that's in line with the utility industry's norm, despite its increase over the last year. Now, the company's quick ratio has a value of 0.47 times, which shows that there's not enough liquid assets to satisfy current liabilities in the event that operating earnings are unable to. Now, the short-term assets of $14.3 billion do not cover its short-term liabilities of $26.8 billion and do not cover its long-term liabilities of $80.3 billion. Now, operating earnings are increasing, so I'm not too worried about that. And the debt level, the net debt to equity ratio is 136%, which is considered high. And the debt to equity ratio has increased from 128% to 142% over the past 5 years. And it's not well covered. The debt's not well covered by operating cash flow right now of 13.9%. And the interest payments on its debts are not well covered at all by earnings before interest and taxes. They only have a 2.3 times coverage, but they're projected to do better in the next couple of years. I'm not too worried about that at all. So what exactly do the analysts say regarding this utility company? Well, the current consensus is a buy recommendation. The average price target on NextEra Energy over the next 12 months is only $93.76 a share, with a high estimate of 115 and a low estimate of 79. If we go over a few of the analyst reports, the Street Quant Ratings report down here, they have a buy recommendation on NextEra Energy, and it's based on the convergence of positive investment measures, which should help the stock outperform the majority of the stocks that they rate. Now, the company's strength can be seen in multiple of areas, such as its revenue growth, like I said, expanding profit margins that is going into, good cash flow from operations and increasing cash flow, growth in earnings per share, and increase in net income. Now, they feel that the strengths outweigh the fact that the company has had generally high debt management risk by most measures that they evaluated, which I agree with that. They definitely had high debt management. Now, looking at the Forward Equity Research Report, they have a hold recommendation on the company as a result of their systematic analysis of the three basic characteristics that they look at. They look at earnings strength, relative valuation, and recent stock price movement. Now they say the company has enjoyed a very positive trend in earnings per share over the past 5 quarters. And while recent estimates for the company have been raised by analysts, NextEra Energy has posted better than expected results. Based on operating earnings yield, the company is about fairly valued when compared to all the companies they cover. I don't agree with that. It's definitely overvalued. Now, share price change of the past year indicates that it will perform poorly over the near term. I don't think it'll perform poorly. I think it goes through some cyclical, some waves, and I'll discuss that later on. Now, finally, looking at the CFRA report, they also have a hold recommendation on this company. They say that NextEra Energy Renewables had a 19.6 gigawatt renewables and storage backlog as of Q2, but expressed some uncertainty for the completion of 1 to 2 of the gigabytes. Now, in a potentially stricter regulatory environment due to inflation and rising electric costs, they feel that confident that NextEra Energy revenue stability due to the 2021 multi-year rate plan at Florida Power and Light, where we also see potential boost to 2023 earnings through an authorized return on equity increase due to higher long-term treasury yields. Now, despite recessionary risk, NextEra Energy made no changes to the raised 2022 to 2025 earnings per share guidance from the June during Q2 earnings, given NextEra Energy's renewable project backlog and the Real Zero plan to achieve zero emissions by 2045 without offsets. They expect that NextEra Energy to benefit from renewable energy tax credits in the recent past Inflation Reduction Act, and I'll get into that. So let me bring it back over here. So on my buy, hold, or sell recommendation on NextEra Energy, now here are my thoughts. So first, let's go over the U.S. Inflation Reduction Act that the President Joe Biden signed on August 16th. Now, overall, the act gives credence to the 5 to 7% annual average long-term growth outlooks for most utilities. Now, utilities investors are well positioned to earn that 7 to 8% long-term annualized total returns overall, even if valuation multiples compress. Now, utilities will most likely pass the tax credit savings straight on to the customers, so no benefit directly from the act, but should be indirectly benefit from lower regulatory risk as tax benefits offset the bill increases related to the growth investments. Now looking at NextEra Energy, it's a high-quality regulated utility in the state of Florida and has a fast-growing renewable energy business. Now, this gives investors two great things: a secure dividend and industry-leading renewable energy growth potentials. Florida Power and Light, which is NextEra's regulated utility, which benefits from friendly regulations that offer high allowed returns, little regulatory lag, and low customer rates. Florida has had a really strong economy and population growth recently, and it's expected to keep increasing in the years to come. Now, the utility plans to invest up to $34 billion from 2022 to 2025 for its explosion in growth. Now, growth opportunities include continued solar generation build-out, storm hardening investments, and transmission and distribution infrastructure. Now, NextEra Energy Resources has proved to be a best-in-class renewable energy operator and developer. Now, the company was an early adopter of the wind generation, building a competitive advantage by securing some of the country's most desirable locations and locking in a 20-year contract with price escalator clauses. Now, NextEra current plans are to focus more on solar, especially in Florida. About half its planned renewable energy growth through 2025 will be solar. Now, the remaining will be wind and energy storage solutions. Though it's possible that the higher costs could threaten near-term renewable energy development. However, because of the high fossil fuel cost right now, it has helped maintain renewable energy's relative economic advantage. Now, despite the solar policy uncertainty, the company continues to add solar to its backlog, highlighting the strong demand for the renewable resource. For long-term investors out there, it is important to incorporate a low volatility dividend growth, as it is a good foundation for outperformance in volatile markets like we're in today. NextEra Energy accomplishes this by having its recession-proof business model focus on renewables and steady and high earnings growth. The dividend isn't high, but the dividend growth is consistent and high. NextEra Energy continues to trade at premium valuation, of course. Now, the company's earnings are inflation resistant. The Senate passed that Inflation Reduction Act. Is a boost to NextEra Energy. Wall Street consensus right now is bullish on this company, but suggests there's little potential for price appreciation. You're not really buying in the stock thinking it's going to go from $90 to $200. You're buying it for steady, slow and steady. Now, the market implied outlook, calculated from options prices, continues to be bullish, albeit with a fairly high volatility. So based on all of that, I am a buy recommendation on NextEra Energy with a 12-month price target of around $93 to $95 a share. But you need to time this perfectly because people are currently buying it over the next couple days to receive the upcoming dividend that pays out September 15th, 2022. I would wait for this dividend payout and give it a couple weeks and buy on the next dip. And I would say possibly around $80 to $85 a share. I would hope for about $80 a share. This has been a cyclical company on its way up. So right now it's on the uptrend. It's going to come back down a little bit and it's going to go back up. So I would wait a couple weeks this out and buy it at around the $80 price. Now, the current valuation isn't extremely cheap. I recommend investors buy and accumulate these shares on the weakness dips in the future. Now, this would be your long-term low volatility dividend yield play. I never suggest you buy the run up to the dividend deadline. So anytime you're hitting the deadline for the dividends, you're always going to see this peak in the price. Now, the bulls on this company say specifically, the FPL operates in one of the most constructive regulatory environments with numerous capital investment opportunities. It has benefited from new renewable energy federal tax credits, but state renewable portfolio standards, corporate purchases, and attractive economies are now driving the investments in renewable energy. Management's long runway of capital investment opportunities support their industry-leading 10% annual earnings growth outlook through 2025. Now, let me go over some of the risk to this recommendation and target price, which include unfavorable regulatory or legislative outcomes and weaker economic conditions and NextEra Energy's service territory. That's possibility. The U.S. Department of Commerce anti-circumvention investigation regarding the import of solar panels from certain Asian countries creates uncertainty for the company's development program and broader federal solar policy. So we don't know exactly where that's going to land. And NextEra's aggressive investment plan increases regulatory execution and inflationary risk. And with the regulated utilities, any rising interest rates will raise financing costs and could make the dividends less attractive for income investors. But what are your thoughts? Please leave your comments down below. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell for your daily stock and cryptocurrency reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.